We're going to deal with accounting for the disposal of depreciable assets. So, when we sell our asset, when we sell an asset, we have to basically not just write the asset off of the books. We also have to write the depreciation off of the books. For that, you know, we can't depreciate an asset any longer that we don't own. So we have to get both items off of the books, okay? So first things first, we have to bring the asset up to date for depreciation. What was the question? Did somebody have a question? No? Okay. All right. So first things first, we have to bring the asset up to date and post the depreciation up to that point in time. So if we purchased an asset in January and we sell that asset 3 years later in June, that means for that January to June period of time of that last year, we have to record that depreciation expense for that particular year and bring the asset up to its book value. So that's the first step whenever we're going to discard an asset. First step is to bring up the depreciation up to date. So then step 2 is we're going to journalize and post the entry to discard the asset. So let's say we have this example. An equipment has a carrying value of $3,700 at the time of its disposal. The carrying value is computed as the cost minus accumulated depreciation of $9,300. A loss equal to the carrying value should be recorded when the machine is discarded, and it would look like this. So when we sold this asset, it's going to look like the entry is going to look like that. This accumulated depreciation machinery, $9,300. Loss on disposal of the machinery because we sold it for $3,700. Okay, and then the machinery, the actual book, what cost the machinery, what we have for the cost of the machinery is $13,000. Okay, so remember, always our debits and credits have to equal each other. So if we sold this particular asset, which had a carrying value of $3,700, and we didn't sell it for anything higher than that $3,700, then that's what happens. We're ending up reporting a loss of $3,700. Now, we're going to look at disposing of an asset that we sell for cash. Again, we're going to bring the entries up to date for depreciation. And then we're going to journalize and post an entry to record the sale of the asset. We're going to sell it for cash of $3,700. So in this particular case, we're actually getting cash in for the sale. So now we're going to record a debit to our cash. We're going to, again, write that depreciation off the books. Why am I debiting the accumulated depreciation? What's our normal side value for accumulated depreciation?
Debit. 50-50.
Credit. Okay? It's a contra asset account, okay? So now we're going to get that accumulated depreciation off the books. What are we going to do? We're going to debit it, okay, to get it off of the books. Same like with the machine itself. Once we sell it, machine's normal side balance is the debit. So if it's off of our books, to get it off of our books, we're going to credit that account, okay? Now we do cash received less the carrying value is going to recognize the loss. So in this particular entry below, we see that they got in cash of $2,000. We're going to again get that $9,300 off the books. And because we only got in cash of $2,000, we're now recording a loss of $1,700 because again, what was our carrying value? Our carrying value on the books was $3,700. So if we only got in $2,000, we're recording a loss of $1,700. Okay? And a loss is going to be treated like any other expense for our business. It's going to be a debit. Okay? So our loss is $1,700. And again, we get the asset off the books by crediting it for $13,000. Disposal on plant assets sold for cash, where we're going to receive more than the carrying value. So in this particular case, we have a gain on the sale of our machinery. So in this case now, we get in actual cash of $4,000. We again have to get that accumulated depreciation off the books. We again have to get the machinery off the books. And now we're recording a gain on the sale because we sold it for $4,000. How much higher is that? Okay, so we're going to say what we gained above the carrying value. Our carrying value was $3,700. Remember, our carrying value was $3,700. So if we got in $4,000 and our carrying value was $37,000, the gain is $300. Okay, so like when we earn revenue, we credit our revenue. Same thing, when we have a gain on the sale of something, we record it as a credit. It's a positive impact on our net worth. Okay, explain exchanges of plant assets. Property, plant, and equipment. Businesses can dispose of plant assets by trading them in on a purchase. And accounting for the exchanges of plant assets is similar to what we just did with our sales. So this is like when you have a trade-in. Okay, if you have a trade-in on an asset, you're going to do similar steps to what we just did when we sold them. Last couple of sections here. Natural resources. When we talk about natural resources, we're talking about any types of long-term assets that are going to be converted, so to speak, into inventory. So we're typically talking about like mining, trees where you're going to convert the cut trees into either some sort of paper pulp or wood. Okay, so you're converting that long-term asset and you're doing something with it to convert it into an inventory item. It's also, these are also called what we say wasting assets. Timber, gas, coal, other minerals, okay? They're going to be wasted as they're extracted and converted into inventory. So as what we call deplete or exhaust these natural resources, we transfer them from a long-term asset into an inventory asset through the process of depletion. Okay, and as the assets are used with natural resources, they're depreciated over a shorter life of the asset or the natural resource. I'm not going to give you any problems on depletion, okay? Because we just don't have enough time to really go into it. Okay, and lastly, intangible assets. Just so you know, same thing with intangible assets. The intangible assets are going to be reduced. The value of them is going to be reduced over time. The method that we do this with is similar to depreciation, except it's called amortization. Intangible assets are any of those assets that have no physical substance. So a trademark, a patent, the goodwill of purchasing one business when you purchase a business from another business, all of those different rights or advantages or values have to be allocated, the cost of them has to be allocated over time. We define a useful life for them, so patents might have a useful life of 17 years. Copyrights might have a longer period. Okay, items with indefinite useful life. There are certain regulatory implications to those things, and again, if we were going into more detail, we would spend more time talking about it. Okay, research and development costs, computer software costs, and goodwill are all items that are amortized over their useful lives. And there's a little table on the upcoming page that shows all the different types of items that are amortized over their useful life. One last thing I'm going to give you guys back right now, really quickly. You guys have problem E10 and E13 to do for homework. E10 is just finishing that last part, and E13 is just an additional problem.